I'm happy that it's gone up because we own a lot of gold-related securities. But as you pointed out earlier, it did pull back a little bit, and it's been a fairly controlled move. But we're big believers when an asset class or security makes a multi-year new high, in this case, an all-time new high. That's a very bullish signal. It typically will keep on going. Now, oftentimes, interestingly, it goes up about 20%, then it kind of consolidates, and that's exactly what we've seen so far. But long term, I do think gold goes a lot higher. Could it be 5,000? Could it be 10,000? I don't know. I know there's a belief that the U.S. is going to have to try to collateralize, if you will, its treasuries outstanding with gold, and they're going to have to do it at a much, much higher gold price because they don't own that much gold.
Schroeder Investment Management and UBS Global Wealth Management are bracing for a rocky second half, and gold has emerged as a preferred trade to navigate the volatility, according to interviews with their chief investment officers who were recently on roadshows in Asia. David Hay, a seasoned investment advisor and financial author, discusses the impending economic crisis, the current U.S. economy, and the gold rally. In his analysis, David Hay predicts that gold prices will reach up to $10,000, especially if the U.S. needs to collateralize its treasuries with gold at higher prices. One possible scenario is that gold prices will keep rising this year. Although the precious metal has dipped down a bit below the recent record gold value, it remains up substantially for the year and could surpass previous highs. Regarding investment strategies, Hay recommends focusing on gold miners, which are beginning to show positive earnings. Despite gold's rising prices, there are still outflows from gold ETFs indicating a general apathy towards the sector. Hay emphasizes that gold miners are even more undervalued while gold is neglected. The gold miners will soon report what will almost certainly prove their best quarter ever. Mostly due to second quarter record-shattering gold prices, gold miners' earnings should soar off the charts. Those will be further boosted by slightly lower mining costs, many of these companies are predicting. With such solid fundamentals, more professional fund managers should soon start investing in this high-potential sector. From David Hay's perspective, there is a precise prediction that wealthier consumers benefit from higher interest rates, while lower-income consumers and small businesses face significant struggles. He highlights rising bank failures and increasing loan defaults as indicators of mounting financial stress. Now we present the clips of David Hay's insights from his recent interview with SOAR Financially. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
I'm happy that it's gone up because we own a lot of gold-related securities. But as you pointed out earlier, it did pull back a little bit, and it's been a fairly controlled move. But we're big believers when an asset class or security makes a multi-year new high, in this case, an all-time new high. That's a very bullish signal. It typically will keep on going. Now, oftentimes, interestingly, it goes up about 20%, then it kind of consolidates, and that's exactly what we've seen so far. But long term, I do think gold goes a lot higher. Could it be 5,000? Could it be 10,000? I don't know. I know there's a belief that the U.S. is going to have to try to collateralize, if you will, its treasuries outstanding with gold, and they're going to have to do it at a much, much higher gold price because they don't own that much gold. That could happen. That's certainly one of the upside kickers. But I guess an easier way to play it is to look at the miners where they have lagged so significantly, though some of them have really good moves lately, but there's still some that have lagged that are starting to report very positive earnings surprises. We wrote one up actually yesterday in our newsletter for our paying subscribers that it was courtesy of Fred Hickey. Fred, you should have Fred on your show if you haven't. He's terrific in the gold space, and he knows the gold miners inside out. I've made a lot of money buying Fred's mining ideas. So I think that's a way, particularly on any weakness, to take advantage of this gold bull market, which I do think is still got a lot further to run. But it's going to be wild. And I think when the trouble with commodities, and I see this all the time in energy, is they hear the story and they go, gosh, it sounds like energy's got to go higher. And they buy it, it runs up, they buy more, and then the correction comes. They go, oh, God, that was a bad. I'm now down because of buying at a higher price. And so they give up on it, and then they miss the huge move. So you have to, I think, part of it is when you do get these strong rallies that happen periodically, take a little bit of money off the table. And we've actually done that with the precious metal related securities. We've taken some money off the table into this rally. The analysts have not raised their numbers for this higher price. And margins, according to Fred Hickey, and I think he's right, the margins are going to be up like 40%. And yet the estimates are basically what they were when gold was still 1900, 2000. So I do think there's a definite potential for some very positive earnings reports that finally get the attention of the analyst community. Because gold, I mean, we're getting even the miners look at gold ETFs. I mean, they're still getting outflows from gold ETFs, not inflows. So there's tremendous apathy towards this area. But the miners, if gold is neglected, miners are detested. I've said this before to other bright people like like yourself, that it's very much a tale of two consumers. Just like I think it's a tale of two corporate sectors too, because the tremendous increase in interest rates for the wealthier investor is manna from heaven. That money that they were earning virtually nothing on, they're now earning 5%. And so so if you think about the federal interest rate, interest cost, how much it's gone up from say 500 billion to a trillion, that extra 500 billion is just rocket fuel for the high end consumer. I think that's why you're seeing articles about how American tourists in Europe are really propping up a lot of those economies over there. So the affluent are feeling very affluent, and they're traveling and they're spending, and so it's and small businesses, which those guys are the main job creators and destroyers, and their interest rates are going up sharply, have gone up sharply. So in many cases, they're paying 9, 10, 11%. So I think what you're starting to see is, well, first of all, there is a spike of bank failures for sure. There's also been a major breakout to the upside of credit card defaults, auto loan defaults. So you're seeing plenty of signs of stress. You're even starting to see that in the shadow banking system with some of these private credit deals going down and having to be restructured. So I think there's plenty of early warning indicators that are, that are starting to flash at least yellow.
During the interview, David Hay stated that the U.S. Treasury market faces complexity, with smaller countries acting as significant buyers. As foreign central banks reduce holdings, Hay emphasized the increasing reliance on U.S. retail investors and banks, highlighting the fragile nature of the Treasury market moving forward. Unsustainable growth in the net foreign debt could lead to foreigners at some point reevaluating and reducing their U.S. asset holdings. If this happens suddenly, it could lead to financial instability and a sharp decline in the dollar's value. Alternatively, if the growth in debt declines gradually, it is unlikely to be destabilizing. Moreover, Hay's analysis points to a fragile long-term Treasury market due to Federal Reserve tapering and bond maturation. He anticipates heightened short-term issuance exacerbating market challenges, suggesting potential stealth inflation to manage mounting debt burdens. Let's get back to the interview.
I think it's tough. I mean, well, what I do see is that you see reports of certain countries being big buyers of treasuries like Luxembourg. And I think another one is Cayman Islands. But these countries that are rather, very small, but are yet huge buyers of treasuries. How can that be? Well, I think it's because they're basically conduits for hedge funds. So I think that's what's making it a bit trickier too. Even if you do identify that data could be misleading, but what's clear is the major foreign central banks are divesting or not increasing their U.S. treasuries. So with this tremendous surge of issuance, who's picking up the slack? And I think, frankly, what's happening is it's a lot of U.S. retail and the banking system, which have been the main buyers, because the Fed, as you kind of alluded to, is no longer, they're not doing QE anymore. They've been doing QT, which is where they shrink their balance sheets. So they've actually been letting their bonds mature. So you've lost the two biggest buyers of treasuries between foreign central banks and the Fed. So I think that's why you're seeing this dynamic in the treasury market where so much of the issuance is at the short end, because the long end is very fragile. And you would think that with short rates higher than long rates, they would want to sell some debt further out to lower the interest costs. But when they try to do that, it seems to swamp the market. So it's a problem, and there's just no two ways about it. It's the Treasury and the Fed have got themselves into a very difficult situation. And personally, I think the only way they get out of it long term is with kind of stealth inflation, and where they tell you inflation is 2 or 3%, and yet there's actually if you've heard of this Chapwood Index, they just did an analysis of the actual cost of living in the 50 largest U.S. cities last year, and it ranges from like 8 to 13%, way above the official inflation number. It was the same thing in 2022, and just as on a personal basis, that's what my wife is constantly telling me. She, power shopper, she goes to the grocery store and she's saying these prices aren't up 25% from 2019. They're up 50, 75, 100% or more from where they were in 2019. And I think a lot of people feel that way. And if you look at like the CPI doesn't include the cost of homeowner insurance, and homeowner insurance was up last year about 30%. So there's a lot of funny stuff going on with the inflation numbers, and some of it I think is just there's a lot of noise. There's some things are up, some things are down. There's definitely been cooling when you talk about commodities. There's been a lot of commodity price weakness over the last couple of years until recently. And you mentioned gold. I mean, gold has definitely perked up, and I think that's a worthy discussion to have. Is how well is the stock market doing in real money? Because I think so much of the appreciation we've seen in recent years has been a function of currency debasement. So if you adjust S&P returns for the price of gold, they don't look too good.
Gold prices recently hit a record and might not be done climbing. Some experts predict gold could rise to around $2,500 or even north of $2,600 per ounce, yet others predict a reversal from record gold prices. How might the changing dynamics in the market impact your investment strategies toward gold in the coming year? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.